오늘은 BCA리서치의 피터 베레진 글로벌 수석 전략가를 모시고요. 올해 미국 주식시장과 금리 전망, 통화와 원자재까지 이 다양한 자산군에 대한 뷰를 들어보려고 합니다. 베레진 전략가는 골드만삭스의 시니어 글로벌 이코노미스트, IMF 조사부, HSBC 주식전략 글로벌 책임을 지내 월가에서 잔뼈가 굵은 투자 전문가로 꼽힙니다. 지금부터 그의 이야기 한번 같이 들어보시죠. Good morning, Mr. Berezin. Thank you for having an interview with us.
My pleasure.
First, I want to talk about the U.S. stock market. BCA has set a year-end S&P 500 target for 3,500, which is a bit of conservative side compared to other research firms. So, could you elaborate on this reasoning behind the projection?
Yeah, well, it's quite a bearish forecast, but it's not an implausible one. We do expect the U.S. to fall into recession next year. And typically, stocks fall during recessions.
You mean this year?
Later this year. So we expect the recession to start
the
second half of 2024.
Okay.
And we expect the S&P to trade down to 16 times forward earnings at the trough, which is not very aggressive. If you look at the average P multiple between, say, 2012 and 2019, it was actually slightly below 16. So we're not forecasting anything too dramatic. And of course, that period between 2012 and 2019 didn't even feature a recession. And we do expect a recession later this year. And we're also assuming that earnings estimates fall by about 10%, which again is not dramatic. So you can still come up with a fairly bearish price target for the S&P based on these fairly conservative assumptions, because the S&P is trading at a very valuated level right now. You don't need a deep recession to drive down stocks. If you think about the 2001 recession, this was the mildest recession in history. After all of the GDP revisions, only 1/4 of negative growth, and yet the S&P still fell 49% peak to trough.
So you expect a recession end of this year and the next year too?
We expect it to start in the second half of this year.
Second half of this year, okay.
To continue into 2025.
And markets have recently lowered expectation of March rate cut. And when and by how much do you think the Fed will lower the interest rate this year?
So I don't think the Fed is eager to start cutting rates aggressively anytime soon. And the reason is that unemployment is still quite low. And there's a risk of being too proactive in cutting rates because it could stoke inflation. So I think the Fed will wait until the recession is already upon us, unemployment is rising, and then they'll cut rates, and they'll cut rates quite aggressively. And we expect the Fed funds rate to eventually reach 2%, probably by early next year, with the 10-year Treasury yield dropping to 3%. So we don't expect a lot of cuts in the next 6 months, but after that, we will see substantial cuts in interest rates.
When the recession comes for real, you mean like second half of the year, then they will start a rate cut.
That's right. Yes.
So like you talked a little bit about like 10-year Treasury yield projection, and like the US 10-year Treasury rate is back above the 4% right now. Today it's about like 4.1. One of the reasons for this is maybe the market now lowered the expectation of the rate cut that we mentioned earlier. So what is your outlook for the Treasury rate, especially US 10-year Treasury?
Well, as I said, I think we're going to get down to 3% on the 10-year Treasury by early next year, which would imply, substantial upside from owning ETFs like the TLT or just owning treasuries by themselves. I want to distinguish between my cyclical view and my structural view. Cyclically, because of the recession, bond yields will fall. But structurally, I think there will be upward pressure on yields over the remainder of this decade because baby boomers are retiring. They accumulate a lot of savings, and now they're going to go from working and saving to being retired and dis-saving. And so that pool of savings will dry up, and that could push up yields. Structurally, budget deficits are likely to remain elevated. That's something that could lead to higher yields than what we've seen in the past. And of course, globalization is also challenged right now. That was historically a very deflationary force, which is likely to go away. So we'll get down to about 3% on the 10-year. But then after the recession ends, I wouldn't be surprised if we'll make our way back to 4 or even 5%.
So, as you said earlier, employment data suggests that U.S. labor market it's cooling more slowly than expected. So, could it be the sign that U.S. recession will be pushed back a little bit further?
Well, I think it depends on which indicators you look at. If you look at the unemployment rates, it hasn't really increased. If you look at initial unemployment claims, if anything, they've been falling, hitting a new low just today. But then if you look at other indicators, it's more worrying. So job openings have been declining now for close to 18 months. Fewer people are quitting their jobs. Often when people quit, it's a sign that they're very, very confident, but now they're quitting less, suggesting that their confidence in finding new work is eroding. The number of temporary employees in the US is dropping. Usually firms stop hiring temps when labor demand begins to cool. If you look at the hiring rate in general, it's very low. It's now well below where it was prior to the pandemic. And that's concerning because firms typically stop hiring before they start firing. So the next step might be to see more layoffs. And if that happens, unemployment could start to rise quite quickly.
Yeah, like you said, it's different from the data to data, but still, like recent strong job data and like there was a data that wage growth is still going on. So how do you interpret those job data like that suggests the strong job market?
Well, wage growth was a little bit stronger if you look at average hourly earnings in the last payroll report. But even that series is trending lower. Most indicators of wage growth, the employment cost index, the Atlanta Fed wage tracker, they're all coming down. Now, they're still quite high relative to where they were prior to the pandemic. And arguably, that higher wage growth is not consistent with 2% inflation. But it's also important to note that wage growth is a very much a lagging indicator. If you look at those job openings, that quits rate, various business surveys, which tend to lead wage growth, they do suggest that wage growth will slow further. And the last point that I would make is that we did have about 40 years where wage growth was slow in relation to productivity growth. And as a result, the share of income going to the owners of capital businesses increased at the expense of labor. If the reverse happens, then it's quite plausible to envision a scenario where wage growth ends up being somewhat higher than it would have been otherwise. But inflation still falls to 2%, and those profit margins end up having to shrink a bit.
So let's move on to like more specific stocks. What are your thoughts on the Magnificent Seven? They lead the stock market last year. And could they continue to lead the stock market this year too?
Well, I think these are great companies, which is why they're so richly valued. But because they are richly valued, they're also vulnerable to a reassessment of how much profits they can actually deliver to shareholders. Taken together, the so-called Magnificent Seven account for about 26% of the S&P 500. We haven't seen a market so concentrated in a few big names since 2000, and before that, 1929. Of course, we know what happened to stocks in 1929.
Yeah, all the bubbles.
They went down. Exactly. They went down. And so there is a risk of these Magnificent Seven deflate. If you look at overall revenue growth for the Magnificent Seven, it's actually slowed over the last few years and now is barely faster than nominal GDP growth. So companies such as Apple, Tesla, Amazon, they are seeing slowing growth, and that could continue. And so I wouldn't be surprised if the Magnificent Seven end up not being so magnificent as far as investors are concerned over the next few years.
Well, let's move on to the like little bit broader topic here. And U.S. stocks have been outperforming global markets over the few decades. So how long do you think this kind of trend can be persist?
Yeah, I mean, if you look at why the US has outperformed, it's been largely a story, not exclusively, but largely a story about tech in the US dominating the global marketplace. And those companies that have done especially well have done so to a large extent by exploiting kind of natural monopolies. So people use YouTube because everybody else uses YouTube. People go on Instagram and Facebook because that's the place to go for social media. So when you have kind of these natural monopolies, of course you can be very, very profitable. But now what we're seeing is that these companies are under attack from regulators. Antitrust actions are being filed. And in some cases, these companies are under attack from one another because they're all competing for the same viewership, which I think makes them, to some extent, vulnerable. And so, again, I think that anyone who is extrapolating the success of the Magnificent Seven far into the future is making a mistake. If some of these companies, if not most of these companies, stumble, US stocks in general could begin to underperform because they are quite expensive relative to other stock markets. In fact, the gap in the P ratio between the US and the rest of the world is as high now as it's ever been.
So you think that behind US stock markets outperform compared to global market is the tech stocks that are have a natural monopoly. So do you think that kind of trend can be changed in a few years or something?
Yeah, I think it can be. And in fact, AI may not be the profitable driver for a lot of companies that many investors assume. Like, for example, if you have a search engine which is very accurate in telling you everything that you ask it, and you ask it, okay, I want to fly from, Montreal to Miami, and it tells you exactly which flight to take, exactly which time, the one that is the cheapest. I mean, that's very useful information. But if it's a good search engine, if it's a good kind of AI chatbot and tells you all of this stuff, like, how do you actually make money from that? Google makes a lot of money because their search engine is good, but it's not great. You still have to click on a bunch of links at the end, and that's how Google makes the money. But if the AI chatbot just tells you all of this, then in some sense it becomes more difficult to monetize all this. And maybe companies will figure it out, but it might take them a while to do so. And in the meantime, the profits that a lot of people are expecting from these tech companies may fail to materialize.
Oh, that's an interesting view. If you assume the shift in the trend, other than US stock market, which reasons or markets do you suggest keeping an eye on as a potential alternative to the US stock market?
Yeah, I mean, I think there is some opportunities in Europe, some opportunities in Japan, and certainly at the sector level, there are certain sectors that I think have sort of been shoved aside in favor of tech, which may actually do quite well this year. So the one sector that I like the most for 2024 is healthcare. It's a very cheap sector. It's a very defensive sector, which of course is important if you believe, as I do, that we're heading into a recession. And it's also a sector where we could actually see some pricing power because many prices in the healthcare sector are negotiated subject to long-term contracts, and these contracts are being renegotiated now, and we could see a little bit higher profit margins from some healthcare companies. So it's not all about tech. There are other sectors out there that could be quite interesting.
Yeah, talking about Japan, Japanese stocks have been broken through the highs of the 1990s. So do you believe this kind of upward trend is sustainable?
Well, it depends a little bit on whether we're talking about Japanese stocks measured in yen or Japanese stocks measured in.
That's a great
So in dollar terms, Japanese stocks haven't done very well over the last 12 months, or at least they haven't done spectacularly well. Let's put it that way, because the yen has weakened. Now, what could happen later this year is that the yen will strengthen. And it might strengthen because we have a recession and central banks around the world will be cutting rates. The Fed will be cutting rates. The ECB will be cutting rates. But the Bank of Japan, never having raised rates, won't be able to cut them. And so rates will move in favor of the yen, and the yen could soar. Now, if that happens, if you're invested in Japanese stocks in dollar terms, it helps. But at the same time, a stronger yen is going to really hurt Japanese companies, especially those that are major exporters. So I'm not wild about Japanese stocks. Would have sort of a neutral weight to them.
So you think there is a possibility that Japan turns to tightening this year?
I think it's possible that they'll try to tighten once or twice. But if I'm right about the recession call, then it won't be much in the way of tightening from Japan. The strength of the yen this year will be more due to the fact that other central banks will be cutting rates rather than the Bank of Japan raising rates. And of course, the yen is a very cheap currency these days.
Right now it is.
And undervalued relative to the dollar. A lot of short positions in the yen. And so we could see some short covering later this year. I think owning the yen is actually a very good hedge against downside risk to global equities.
Yeah, so let's move to the gold. So because these days with central bank increasingly high, likely to cut the interest rate. So gold has been rising above like 2,000 per ounce. So what is your outlook for gold?
Gold's been quite interesting over the last few years. Before, let's say, 2021, there was a very consistent relationship between the price of gold and real interest rates, which makes a lot of sense because the opportunity cost of holding gold is the interest rate that you would get by taking that cash and putting it into a bank account. If you own gold, you're not earning any interest. And so that ends up being a problem in an environment where interest rates are high. So one would have thought perhaps that as interest rates rose, the price of gold would fall, but it didn't. It didn't fall. It actually went up somewhat. Now, why did that happen? It wasn't because a lot of retail investors were flooding into gold. In fact, the amount of gold held in ETFs, like the GDP, has declined over the last 3 years. It really was a story about central banks buying gold and pushing up the gold price as they did so. And that could very well continue for many years. So gold is expensive. Relative to its long-term history, it's not a cheap asset, but it does have that support from central banks, which isn't going to go away. And so I can't be too bearish on gold.
And these days, the Bitcoin spot ETF is released. So do you think that can happen to the Bitcoin, like it happened to the gold?
Well, I think Bitcoin is an interesting asset in that its value primarily stems from kind of these network effects that we discussed earlier. People think Bitcoin has value, and hence Bitcoin has value. But there's no real underlying value in Bitcoin in the sense that it generates income for its holders. And that does make it quite vulnerable. I think for Bitcoin to maintain its value, it's going to have to find something that people want to use it for besides speculation and, in many cases, to be frank, criminal and fraudulent activities. And so far, that use has not really become apparent. Bitcoin has been around for about 10 years, and it's still not widely used in e-commerce. People hold it as an asset, but what underlies that value, that remains unclear. So I think until I see a clear use case for Bitcoin and other cryptocurrencies, I'll be rather skeptical of them.
But talking about underlying value of the Bitcoin, isn't the gold is the same? Like there is a not real underlying value for the gold.
And you can say that for money as well. But in the case of money, you've got governments that underlie the value. In the case of gold, you have a scarce commodity. Gold is fused in the collapse and collision of neutron stars, and that's not something you can easily create. Now, it's true that Bitcoin is limited in supply, but the overall number of cryptocurrencies is not limited in supply. You can create as many cryptocurrencies as you want, which does kind of raise more of a risk around crypto than it does around gold, which truly is limited in how much there is of it on this planet.
So we found another planet that have a lot of gold if
Well,
that
good luck with
happens.
that.
So thank you for sharing your insight and have a wonderful day. Thank you, Mr. Burzen.
Thank you to you too.